So what does this massive global surge in Ozempic prescriptions have to do with the profit margins, like a multinational soybean supplier?
Well, usually absolutely nothing.
Right, nothing at all. But right now, this pharmaceutical trend that's fundamentally altering human digestion, it's actually forcing one of the biggest, most entrenched agricultural giants on the planet to, well, completely rethink how they make their money. Welcome to the Deep Dive.
Thanks for having me.
Yeah, today we are opening up the Q4 and full year 2025 earnings call transcript from the Daniels Midland Company, or, better known to the markets simply as ADM.
Right, ADM. And I got to say, it is just a phenomenal case study in downstream economic butterfly effects. Because ADM is essentially the invisible engine of the global food and fuel supply chain.
Yeah, they really are everywhere.
Exactly. I mean, you interact with their products daily, whether it's the sweetener in your coffee or the feed that raised the chicken on your dinner plate, or even the biofuel blended into the gas tank of your car.
Yeah.
But analyzing their current financial health, it requires looking way past simple quarterly profit and loss statements. Because right now, they are navigating this deeply complex macroeconomic web.
Right, which is what Talk Tickers is all about. We want to translate all of that dense Wall Street corporate jargon into the actual mechanical reality of how this company operates.
Exactly.
Because our mission with this deep dive, for you listening, is to break this down into a few core pillars. We're going to look at the raw headline numbers the executives reported to the street.
The data-forward approach.
You know it. And then we'll dive into the physical, real-world story driving those numbers, unpack the management's guidance for the future, and ultimately we'll distill the bottom line for you, whether you're holding the stock in your portfolio or just trying to, understand the global economy.
I love it. So to set the baseline here, ADM's 2025, it was universally characterized on the call as a transitionary and difficult market.
Highly difficult, yeah.
Yeah. Management had to aggressively optimize their internal operations because the external macroeconomic forces were just largely hostile to their traditional profit centers.
So let's hit the headline numbers then. The core financials they delivered to the market under those really tough conditions.
Right. So for the fourth quarter of 2025, ADM reported an adjusted earnings per share, or EPS, of 87 cents.
Okay, 87 cents.
And then zooming out to the full year, the adjusted EPS landed at $3.43.
Got it.
Total segment operating profit, that came in at $821 million for the fourth quarter, which brought the full year operating profit to $3.2 billion.
See, $3.2 billion in operating profit, that sounds like a massive success to the average person. I mean, it's a huge number.
Oh, absolutely.
But, in the context of a company the size of ADM, Wall Street is always looking for efficiency, not just raw scale.
Right. They want to see how hard that capital is working.
Exactly. And they reported a trailing fourth quarter adjusted return on invested capital, the ROIC, of 6.3%.
Which is,
Yes,
fine.
Right. It's fine. But the number that really jumps off the page in this transcript, it actually isn't the profit margin. It's this detail regarding their internal cash management.
Oh, yeah. You're referring to the $1.5 billion cash flow benefit they realized.
Yes, that's exactly it. Management made it a point to highlight this as a major operational victory. And I feel like it deserves a deep dive on its own because of how they actually achieved it.
Because it didn't come from sales.
No, that $1.5 billion did not come from some magical surge in sales or a massive reduction in headcount. It was extracted purely from working capital efficiencies, specifically through rigorous inventory reduction and sharpened demand forecasting algorithms.
And we really need to ground that in reality for a second, because when a typical tech company talks about reducing inventory, they mean, keeping fewer laptops in a warehouse.
Right. A few less pallets of iPhones or whatever.
Exactly. But when ADM talks about inventory, the scale is almost incomprehensible. I mean, we're talking about literal concrete silos holding millions of bushels of grain, fleets of barges moving down the Mississippi River, loaded with soybean oil, just massive multi-acre processing facilities.
So how do you find $1.5 billion hidden inside a physical supply chain that massive?
Well, by fundamentally changing the velocity of the commodity.
The velocity?
Yeah, because storing physical agricultural products is incredibly expensive.
Oh, sure.
You have the cost of the physical infrastructure itself. You have the energy required to control the temperature and moisture so the grain doesn't literally rot.
That would be bad, yeah.
Very bad. Plus, the insurance on the commodity. And perhaps most importantly, the cost of capital tied up in that asset.
Right. Explain that part, the cost of capital.
So if ADM buys 1 million tons of corn and just sits on it for 6 months, that is cash they cannot use to pay dividends or buy back stock or invest in new facilities.
Oh, okay, so it's trapped money.
Exactly. So by utilizing better predictive data analytics, they tightened their forecasting. They started buying raw materials much closer to the actual moment their downstream customers needed the processed goods.
Oh, wow. So just by holding less physical grain for shorter periods of time, they essentially unlocked $1.5 billion that was previously just trapped inside their own silos.
Exactly. It's the ultimate defensive maneuver. When the market is tough and your overall profits are taking a hit, you look inward and optimize the pantry, basically.
That is wild. But there was another major headline from this transcript that actually had nothing to do with cash flow, but everything to do with investor psychology.
The legal stuff.
Yeah, the company announced the official closure of government investigations by the SEC and the Department of Justice regarding their prior reporting on intersegment sales.
Yeah, and that is huge because it removes a significant, unquantifiable overhang on the stock.
Right, a dark cloud.
Exactly. I mean, when a company is under active investigation by the DOJ and the SEC, institutional investors often just hit the pause button.
Because they can't price the risk.
Right. Risk models just cannot accurately price in the potential of massive regulatory fines or forced structural changes to the business. But management confirmed they have released the necessary reports, they remediated the accounting control issues, and they are officially putting these matters in the rearview mirror.
Okay, so the dark cloud has lifted, but let me push back on the broader narrative here.
Sure, go for it.
They just posted $3.2 billion in operating profit, right? They freed up $1.5 billion in cash through sheer operational willpower, and they shook off a federal investigation.
Yeah, sounds great on paper.
Right. Yet, Juan Luciano, the CEO, and the rest of the executive team kept framing 2025 as a deeply challenged environment, over and over again. Where is the actual pain coming from?
Okay, so the pain becomes very clear when we look at the performance of their largest and most historically dominant business unit.
Which is?
Ag Services and Oilseeds, or AS&O. This is the segment that actually buys, transports, and processes the raw crops. So for the fourth quarter, this segment generated $444 million in operating profit.
Okay.
Which represents a steep 31% decline compared to the fourth quarter of the prior year.
Ouch. 31%.
Yeah. And if we look at the entire year of 2025, the segment profit was $1.6 billion, which is a massive 34% drop year over year.
I mean, a 34% drop in the crown jewel of your business is severe.
Highly severe.
And the transcript points to lower North American export volumes as the first culprit, right? It specifically notes that, quote, muted pricing led to limited farmer selling.
Yes.
And I want to pause on that phrase because it assumes a deep understanding of behavioral economics in the farming sector that, well, maybe you and I know, but the average listener might not possess.
Yes, it's not super intuitive.
So walk us through the psychology and the physical actions of a farmer dealing with muted pricing.
Okay, so imagine you run a massive farming operation in the American Midwest.
Okay, I'm wearing a flannel.
Perfect. You've just spent millions of dollars on seed, diesel fuel, fertilizer, and labor to harvest your soybean crop.
A lot of overhead.
Tons. And you watch the futures market on the Chicago Board of Trade every single day. If the global price of soybeans drops near or below what it actually cost you to grow them,
Which happens?
which is exactly what happened for large stretches of 2025. If that happens, you are not going to sell your harvest to a buyer like ADM.
Because you'd be locking in a loss.
Yeah, exactly. Instead, you physically lock the grain inside your own on-farm storage bins. You decide to literally whisk out the market, hoping prices recover in a few months.
Wait, so millions of independent farmers collectively decide to hoard their product, which basically starves ADM's processing plants of the raw materials they need to run at maximum efficiency?
That's exactly it. And at the exact same time, the global buyers, the countries, and the huge companies that purchase bulk grains from ADM, they are looking at the exact same sluggish market.
Oh, so they aren't buying either.
Right. Because prices are muted and supply chains are relatively stable, these buyers aren't panic buying to build up their own reserves. They're just buying hand to mouth.
Just what they need for Tuesday.
Basically, yeah. Purchasing only what they need for the next few weeks. So ADM is caught in a vice grip The farmers won't sell to them at a cheap price, and the international buyers won't commit to massive, high-margin export contracts.
So the volume just dries up?
And that lack of velocity directly destroys their trading and export profits.
That explains the ag services side, but the transcript also highlights a massive hit to their crush margins. And this is a term that needs some serious unpacking for talk tickers.
Oh, definitely.
Because when I hear crush, I think of like a video game mechanic or a soda brand. But in this context, it is the fundamental physics of their business.
Right. So the crush margin is essentially the crack spread of the agricultural world.
The crack spread.
Yeah. It's very similar to how an oil refinery makes money. So an oil refinery buys crude oil, right? And they refine it into gasoline and diesel, profiting on the difference between the raw material and the finished products.
The spread.
Exactly. Well, ADM does the exact same thing with crops. They buy a whole raw soybean, they put it through massive industrial processing facilities, and they physically crush it into two distinct commodities.
Okay, what are the two?
Soybean meal, which is highly protein dense and sold globally to feed livestock like poultry and swine, and soybean oil, which is used for human consumption as cooking oil and increasingly as a feedstock for renewable diesel fuel.
Oh, gotcha. So the crush margin is simply the profit ADM pockets on the spread between what they paid the farmer for the raw soybean and what they can sell the resulting meal and oil for on the open market.
You nailed it.
So here's where the data gets weird. The transcript notes that in the fourth quarter, global crush volumes actually increased.
They did.
Yeah, they processed 4% more volume year over year and 7% more than the third quarter. They even hit all-time record processing volumes in South America.
Record volumes, yeah.
But somehow, their operating profit in the crushing subsegment plummeted by 69%, down to just $66 million.
It's brutal.
I mean, that makes no mathematical sense on the surface. How do you do record amounts of physical labor, process more product than ever before, and watch your profits evaporate?
Because the spread collapsed and the cost to run the machines skyrocketed.
Please explain that.
So the global market was absolutely flooded with soybean products, particularly coming out of South America. And that oversupply suppressed the selling price of the meal and the oil.
So the revenue side of the equation was shrinking.
Exactly. The selling price went down. Meanwhile, on the cost side of the equation, North American manufacturing expenses have remained stubbornly high.
Yeah, the CEO specifically addressed this during the Q&A portion of the call. He pointed out that while the physical performance of their processing plants was excellent, I think he said they had great uptime, meaning the machines weren't breaking down. The actual financial cost of running those plants has just permanently shifted since the pandemic.
Right? You really have to look at the compounded inflation of heavy industry.
It's everywhere.
It is. The hourly wages for the specialized labor required to run these plants, that has increased. The cost of the contractors who perform the maintenance has increased. The energy required to fire the boilers and run the massive crushing machinery increased.
So everything costs more.
Everything. So when the spread between raw soybeans and finished oil is wide, those higher operational costs are easily absorbed. You don't even notice them.
Right.
But when the global market crushes the spread, those elevated North American manufacturing costs just violently eat into the bottom line.
And the transcript also mentions a $20 million negative timing impact as a reason for the crushing profit decline.
Yes, the timing impact.
I mean, honestly, that sounds like a convenient accounting excuse. What does a timing impact actually mean in the real world of commodity trading?
So it's actually a really complex accounting mismatch. It's dictated by how physical commodities are hedged against financial derivatives.
Okay, bear with me here.
I know it sounds dense, but when ADM agrees to buy physical soybeans from a farmer months in advance, they immediately go to the financial futures market and take out a hedge to protect themselves against price volatility.
Basically buying insurance.
Exactly. They're buying insurance so that if the price of soybeans crashes before they can process and sell them, the financial derivative pays out and covers the loss.
That makes perfect sense as a risk management strategy, but where does the timing issue come in?
Well, the accounting rules require ADM to mark to market those financial hedges at the end of every quarter.
Mark to market, meaning?
Meaning they have to report the current value of that financial derivative on their balance sheet immediately. But the actual physical soybeans might still be sitting in a silo waiting to be crushed and sold in the next quarter.
Oh, I see.
So if the financial hedge loses value on paper in December, they have to report a financial loss in the fourth quarter. But the physical sale of the oil and meal that will eventually offset that loss won't happen and won't be recorded as revenue until January.
Oh, wow. So it creates an artificial dip in the current quarter's profit that will eventually wash out, but it makes the immediate numbers look significantly worse than the underlying reality.
Exactly. It's just accounting noise, really, but it hurts the Q4 report.
So the crushing business was just hammered by a perfect storm. You had farmers hoarding grain, global oversupply compressing the margin spread, inflated factory running costs, and an annoying accounting mismatch on their hedges.
A very rough quarter for AS&O.
But tucked into this segment's data is a massive windfall that honestly kind of saved the quarter from looking like a total disaster. Let's look at their equity earnings line item.
Yeah, we have to talk about Wilmar. So ADM holds a significant strategic investment in a massive Asian agribusiness group called Wilmar International.
Right.
And in the fourth quarter, ADM recorded a specified gain of $254 million related to a transaction that Wilmar closed.
Wait, $250 million injected straight into the earnings simply because a company they own a piece of made a lucrative move.
Yep, just straight to the bottom line.
It really highlights the sprawling global nature of ADM's balance sheet. They aren't just a processing company. They are essentially an agricultural holding company leveraging investments across the entire planet.
And that global footprint is crucial to their survival because it allows them to absorb regional shocks.
Yeah.
Like a bad harvest in North America.
Right.
But, regional agricultural shocks are nothing compared to the fundamental shift in human biology that we are seeing play out right now. Which brings us to their second major business unit.
Carbohydrate solutions. And this is where the transcript gets genuinely fascinating.
Oh, it's wild.
Because this segment processes corn and wheat into starches, sweeteners, and bioproducts.
Right.
Now, for the fourth quarter, the operating profit for carbohydrate solutions fell 6% to $299 million. And for the full year, it was down 12% to $1.2 billion.
Which sounds bad.
It sounds bad, yeah. But those aggregate numbers hide a massive internal divergence.
It's a profound tale of two entirely different end markets. Because inside carbohydrate solutions, you have the starches and sweeteners division, which produces the high fructose corn syrup and ingredients that go into global packaged foods. That division experienced severe weakness. But on the other side, you have the Vantage Corn Processor division, which is essentially their ethanol and biofuel operation.
And how did they do?
That division saw operating profits absolutely skyrocket, jumping 187% in the fourth quarter to $43 million.
Okay. Let's dig into the weakness on the human food side first, because an analyst directly asked management about the impact of GLP-1 weight loss drugs during the Q&A.
Yes, the Ozempic effect.
Which is crazy, right? The fact that Wall Street analysts are grilling an agricultural executive about pharmaceutical injections shows how interconnected the global economy has become.
Well, the numbers are undeniable. The mechanism of action for drugs like Ozempic and Wegovy is that they delay gastric emptying and signal to the brain that the body is full, which drastically reduces overall caloric intake.
People just eat less.
But management noted that it isn't just a reduction in total food volume. It is a fundamental rewiring of consumer cravings.
So really?
Yeah, people adopting these medications actively shift their diets away from ultra-processed foods, savory snacks, and sweet-baked goods. And they move instead toward lean proteins and whole foods.
And ADM is the primary supplier of the invisible hypercaloric ingredients that make ultra-processed foods taste so good.
Exactly.
If humans suddenly stop craving sweet snacks, the packaged food companies stop ordering millions of gallons of liquid sweeteners from ADM.
And the data supports that shift. Management stated on the call that liquid sweetener volumes are down anywhere from 5% to 7%.
That's a huge dent for a commodity business.
But we have to look at the broader macroeconomic picture as well. Because it isn't just the GLP-1 effect depressing volume. Inflation has permanently altered grocery store behavior.
Oh, absolutely. I mean, the rate of inflation might be cooling off, but the actual sticker prices on the shelf are still 20% or 30% higher than they were 4 years ago.
Consumers are experiencing severe wallet fatigue. When a family is struggling to pay for housing and utilities, the first thing they cut from their budget are the discretionary, premium packaged snacks.
Oreos become a luxury.
Exactly. They trade down to store brands, or they simply stop buying the highly processed convenience foods altogether. This creates a structural, long-term headwind for ADM's traditional food ingredient business.
And this is where we see ADM's massive strategic pivot playing out in real time. If humans are eating less sugar, Either because they are medicated or because they are broke, ADM cannot just sit there with millions of acres of corn and no buyers. They have to find something else to do with the carbohydrates.
Which is exactly why they are intensely focused on shifting their starch and sweetener products out of the human digestive tract and into industrial applications.
Give me some examples of that.
The transcript details how they are aggressively selling corn-derived starches and polymers into heavy industry. So they are developing carbohydrate-based binders for the construction industry to use in drywall and concrete.
Corn and concrete.
Yep. They are selling dust control agents to mab lining operations. They are replacing petroleum-based chemicals in the production of cardboard packaging and cosmetics with plant-based alternatives.
That is an incredible visual. The same kernel of corn that used to be processed into syrup for a soda is now being engineered to hold up the drywall in a new suburban housing development.
Just incredible.
Purely because human beings are changing their relationship with food.
It's the ultimate display of corporate adaptability. And while they are slowly building out those industrial applications, they are relying heavily on the ethanol side of the business to act as a financial shock absorber.
Let's look at that shock absorber. Because you said the Vantage Corn Processor division, their ethanol arm, saw profits jump 187%, and margins per gallon surged 33% higher compared to the prior quarter. How is the ethanol market booming while the food market is contracting?
Well, the ethanol market is heavily insulated by government blending mandates, which keeps domestic inventory levels artificially balanced.
Yeah.
Regardless of whether humans want to eat less sugar, federal regulations require a certain percentage of ethanol to be blended into the domestic gasoline supply.
So they have guaranteed buyers.
Guaranteed floor, yeah.
Yeah.
Furthermore, ADM capitalized on exceptionally strong export demand. Countries around the world are looking for cheaper, cleaner-burning octane enhancers to mix into their own fuel supplies.
Okay.
And ADM's massive scale allows them to export millions of gallons of ethanol to meet that global demand, capturing those high margins.
So they use the fuel of the present to buy time for the ingredients of the future.
That's a great way to put it.
That brings us to their third major segment, which is supposed to be the crown jewel of their future growth strategy. Nutrition.
Ah, yes, nutrition.
Now, the headline numbers here are confusing to me. Segment revenues for Q4 were flat at $1.8 billion, and operating profit actually dropped 11% to $78 million. If this is their high-growth, high-margin future, why are the profits shrinking?
So the data actually points to something more complex, requiring us to strip out some significant accounting noise.
More accounting noise.
Always. You have to look closely at year-over-year anomalies to understand the underlying health of the business. So in the fourth quarter of 2024, ADM received a $46 million influx of cash from insurance proceeds related to an incident at their Decatur East processing plant.
Okay.
That $36 million was recorded as profit.
So last year's Q4 numbers were artificially inflated by an insurance check.
Exactly. In the fourth quarter of 2025, they received zero insurance proceeds for that plant.
Ah.
So when Wall Street algorithms compare the two quarters, it looks like ADM's profit fell off a cliff, but they are actually starting the comparison with a $46 million handicap.
So it's not apples to apples.
Not at all. If you remove the ghost of that insurance check and look purely at the organic operations, the human nutrition side of the business actually performed exceptionally well.
Yeah, the transcript points specifically to North American flavors. Operating profit in that specific division was up nearly 60%.
60%.
That is staggering organic growth. But what is driving that kind of demand for flavors when we just established that people are buying fewer packaged foods?
It comes down to reformulation. Because consumers are demanding healthier profiles, lower sugar, lower sodium, higher protein, more plant-based alternatives.
Right.
But the food and beverage companies are desperate for sophisticated flavor systems because when you remove sugar and fat from a beverage, it tastes terrible.
Yeah, you have to replace it with something.
Exactly. You have to replace it with complex, natural flavors to make it palatable.
Yeah.
ADM is selling the proprietary flavor science that allows these massive consumer brands to reformulate their products without losing their taste profiles.
Oh, that's smart.
They also noted very strong sales in biotics, which caters directly to the booming consumer interest in gut health and microbiome support.
So human nutrition is humming along beneath the surface noise. But the other half of this segment is animal nutrition, and the story there is completely different.
Very different.
Because the Q4 numbers were soft, down 15% due to some localized volume issues. But when you zoom out and look at the full 12 months of 2025, The operating profit for animal nutrition was actually up an impressive 66%, hitting $98 million.
Right.
How do you pull off a 66% annual profit jump in a division that sells animal feed during a tough agricultural cycle?
By executing a textbook strategy of shrinking to grow.
Shrinking to grow. Explain that.
Management made a very calculated decision to stop chasing pure volume and start ruthlessly defending their margins. They conducted a massive portfolio optimization, essentially looking at every product line in the animal nutrition division and cutting the dead weight.
Okay.
If they were selling a low-margin commodity feed that was dragging down their overall profitability, they simply stopped selling it. They exited underperforming geographies and slashed the associated operational costs.
So they intentionally sold less physical product, but made significantly more money on every pound they did sell.
That's the secret.
And the transcript also mentions a major structural change to this division, a new joint venture with a company called Alltech.
Yeah, that joint venture is a fascinating mechanism for moving up the value chain. Alltech is a massive player in animal health and specialized nutrition. By combining forces, ADM is transitioning away from being a supplier of basic bulk feed and moving toward providing highly specialized, scientifically backed nutritional additives.
Things that improve the health and yield of livestock.
Exactly. The accounting quirk here is that because it is a joint venture, ADM will technically report less top-line revenue moving forward because they only record their equity share of the profits.
Oh, right.
But the actual profit margins generated by those specialized products will be substantially higher than the bulk feed they used to sell.
It is a ruthless, necessary evolution. Cut the low-margin volume, partner with a specialized firm, and focus entirely on the bottom line. Okay, we have thoroughly dissected the mechanics of their past year. We know how they survived the headwinds of 2025. Now we need to look at what management is telling Wall Street about the future.
The fun part.
Always. Let's analyze their forward guidance and the policy variables dictating their fate in 2026.
So the most anticipated moment of any earnings call is the forward EPS guidance. Management set an adjusted earnings per share range of $3.60 to $4.25 for the full year of 2026.
I have to stop right there and look at the math. A range of $3.60 to $4.25 represents a 65-cent spread on earnings per share.
It's massive.
It is. For a company with hundreds of millions of shares outstanding, that is a massively wide chasm of potential profit. Why is a company with over a century of operating history, utilizing the most advanced forecasting algorithms in the world, refusing to commit to a tighter number? Are they simply terrified of overpromising?
You have to look at the external forces dictating that spread. Management explicitly stated that their reluctance to tighten the range is a direct reflection of massive pending variables entirely outside of their control.
Oh, really?
Yeah, their internal operations are highly visible to them, but the regulatory environment they operate within is currently a black box.
Ah!
If we isolate these external forces and analyze them purely as market mechanics, no taking any political sides here, there are three massive swing factors that will decide whether ADM it's $3.60 or $4.25.
Let's break down the mechanics of those three variables. Because the first one cited in the transcript is U.S. biofuel policy, specifically something called RVOs.
Right, so RVO stands for Renewable Volume Obligation. To understand how this impacts ADM, you have to understand the regulatory architecture of the Environmental Protection Agency, the EPA.
Okay, lay it on me.
The EPA dictates exactly how much renewable fuel like ethanol or renewable diesel must be physically blended into the nation's commercial transportation fuel supply every single year.
Yeah.
They issue these mandates in the form of RVOs.
So the government essentially creates an artificial, guaranteed floor of demand for the very product ADM produces.
That is the theory, yes. The problem is that the final government mandate for the upcoming year is still under evaluation. It hasn't been finalized.
Oh, so they're waiting on the paperwork.
Exactly.
Yeah.
And ADM operates an incredibly complex forward-selling machine. They need to sell the processing capacity of their massive plants months in advance.
Right.
So if the EPA announces a massive aggressive RVO mandate early in the year, the demand for renewable diesel will skyrocket, the price of soybean oil will surge, and ADM's crush margins will explode. They will easily hit the high end of their guidance.
But if the bureaucratic gears grind slowly and the EPA delays the announcement or sets the mandate lower than the market anticipates, the opposite happens.
Precisely. If the RVOs are weak or delayed, the lower end of their $3.60 guidance assumes that crush margins will essentially remain flat, languishing in that same compressed state we saw in the fourth quarter.
And timing is everything, right?
Everything. Because they sell their capacity on a forward basis, even if a bullish RBO policy is announced in March, ADM might not physically realize the financial benefit in their cash margins until July.
Wow.
The delay cost them hundreds of millions in potential profit.
That perfectly illustrates the vulnerability of being a massive corporate machine reliant on government timetables. What is the second major variable creating that 65-cent spread?
The implementation of the 45Z clean fuel production tax credits.
45Z, okay.
This is a massive piece of federal legislation intended to financially reward companies that produce low-emission transportation fuels. ADM executives estimate that they could see a direct bottom-line benefit of approximately $100 million from this specific credit in 2026.
$100 million in pure profit just from a tax credit. I mean, that moves the needle significantly. Why is it listed as a variable instead of a guarantee?
Because the Internal Revenue Service and the Treasury Department have not finalized the incredibly complex rules detailing exactly how that credit will be calculated.
The red tape again.
Always. The payout of the 45Z credit is directly tied to the carbon intensity score of the specific plant producing the fuel.
Wait, so ADM literally has to prove the mathematical carbon footprint of their individual factories to the government to get the money?
Yes, and it gets deeper. The legislation also includes strict prevailing wage and apprenticeship requirements.
Okay.
So if ADM's contractors don't meet specific labor standards while maintaining these plants, the value of the tax credit drops exponentially.
Jeez.
So you have a potential $100 million tailwind floating in the ether, entirely dependent on pending government guidance regarding carbon mathematics and labor contracts.
It is wild to realize how much of this agricultural processing company's ultimate profit margin is tethered to the pens of regulators in Washington.
It really is.
What is the third massive variable?
Global trade relations, specifically with China. Throughout 2025, ADM saw very little export volume moving from the United States into China due to geopolitical friction and uncompetitive pricing.
Which we hear about on the news constantly.
Right. However, management signaled on the call that they expect a normalization of those trade relations in 2026.
Okay, and if that happens?
If the geopolitical temperature cools and the massive Chinese pipeline opens back up for U.S. soybeans, it acts as a massive demand shock to the system. It clears out the glut of inventory in North America, drives up prices, and provides a huge volume boost to ADM's Ag Services trading division.
So the narrative is clear. If the EPA mandates heavy biofuel blending, the Treasury finalizes the 45Z tax credits favorably, and China starts buying U.S. soybeans by the millions of tons, ADM sails effortlessly to the $4.25 high end of their guidance.
Yep.
But if those three dominoes stall, they are stuck fighting for $3.60. But, the transcript shows they aren't just sitting in their boardrooms passively waiting for regulators to make them rich.
Definitely not.
They are spending an unbelievable amount of capital to physically build their way out of this transitionary period.
Their capital allocation strategy is aggressively forward-looking. Despite the compressed margins of the difficult operating environment of 2025, they are committing massive sums of cash to future-proof the business.
Like how much?
For 2026, they have allocated $1.5 billion purely for research and development and the expansion of their digital services.
Huge.
On top of that, they're committing another $1.3 to $1.5 billion in pure capital expenditures to upgrade and build new physical infrastructure.
That is nearly $3 billion being poured directly back into the company in a single year. When a massive legacy corporation spends that kind of money, they aren't just repainting the factories. Where exactly is that capital being deployed?
So management outlined 5 specific long-term growth pillars that they believe will insulate the company from the cyclical volatility of commodity pricing.
Let's run through them.
First is enhanced nutrition. They're investing heavily in unlocking specialized high-value markets. A prime example is their development of allergen-free pea protein.
Which is everywhere now.
Yeah, it's highly sought after by consumer brands manufacturing premium, high-protein drinks and nutrition bars.
Okay, what's next?
Second is the expansion of their biotics portfolio, where they are engineering next-generation functional ingredients that combine complex biotics with botanicals to target the booming health and wellness sector.
Gut health again?
Always. Third is biosolutions, substituting petroleum-derived chemicals with plant-based alternatives across industrial applications, like we talked about earlier.
Right, the drywall corn. Let's pause on the fourth pillar, because when I read the transcript, it sounded like science fiction. Precision fermentation.
Oh, it's amazing.
What exactly are they building with that capital?
Precision fermentation is the biological manufacturing of the future. So imagine a traditional brewery making beer. Yeast consumes sugar and excretes alcohol.
Okay.
Precision fermentation uses that exact same fundamental mechanism. But instead of using standard yeast to make alcohol, scientists genetically engineer specific microbes, like bacteria or fungi.
And what do they do?
When you feed carbohydrates to these engineered microbes inside massive stainless steel bioreactors, they excrete highly complex targeted molecules.
So ADM is using their massive supply of corn and wheat as the raw feedstock, the sugar, to feed these genetically modified microbes, which then brew entirely new proteins and enzymes.
Exactly. They can literally brew dairy proteins without a cow, or specific enzymes needed for pharmaceuticals. Wow. It is a wildly high-margin business, and ADM is building the massive, expensive physical infrastructure required to scale this technology for the world.
Which brings us to the fifth and perhaps most consequential pillar of their massive capital spend: decarbonization. The transcript reveals that they are treating carbon not just as an emission, but as a manageable, tradable commodity.
And the physical infrastructure they are building around decarbonization is staggering. The CEO specifically highlighted an ongoing project to connect their massive corn milling plant in Columbus, Nebraska, directly to a carbon capture pipeline.
Let's explain the mechanics of that. Because a carbon capture pipeline sounds conceptual, but it is a massive physical engineering undertaking.
Oh, it's entirely physical. So when ADM ferments corn into ethanol at that plant in Nebraska, the chemical process naturally releases massive amounts of pure carbon dioxide.
Right.
Historically, that CO2 is simply vented into the atmosphere. The new infrastructure physically captures that CO2 gas right at the smokestack, compresses it into a supercritical liquid state, and pumps it into a massive underground pipeline network.
And then it just goes where?
That pipeline transports the liquid carbon and permanently sequesters it thousands of feet underground in deep geologic rock formations.
Why spend hundreds of millions of dollars to bury an invisible gas underground?
Because of the mathematics of carbon intensity. By capturing and burying the CO2, the physical ethanol produced at that specific plant is mathematically assigned a drastically lower carbon intensity score.
And that score translates to money.
Big money. That low-carbon ethanol becomes exponentially more valuable in specialized, heavily subsidized markets. For instance, the aviation industry is desperate for sustainable aviation fuel, or SAF, to meet their own emission targets.
Right. Airlines need to go green.
They do, and they are willing to pay massive premiums for low-carbon ethanol that can be converted into jet fuel. ADM is literally building a multi-year runway of growth projects centered entirely around squeezing the carbon out of their supply chain to capture those massive premiums.
We have covered an immense amount of complex mechanical ground today. We have examined the historical financial data, unpacked the behavioral economics of the farmers and the consumers, and mapped out the massive regulatory variables dictating the future.
We hit it all.
So it is time to synthesize all of this raw data into an actionable thesis for the listener. The talk ticker's bottom line. Let's look at it. If someone is holding ADM stock in their portfolio right now or considering initiating a position, what is the bearish case? What are the structural risks screaming from this transcript that should keep them up at night?
Okay, the bearish thesis is built on three persistent, highly stubborn headwinds that ADM cannot easily wish away.
Hit me.
First, the fundamental unit economics of their North American processing empire have deteriorated.
The inflation piece.
Exactly. The increased costs of specialized labor, contractor maintenance, and heavy industrial energy are not reverting to pre-pandemic levels. Those permanently higher operational costs will continue to squeeze their profit margins on the crushing side every time the global commodity spread tightens.
Okay, that's one.
Second, the systemic softness in the packaged food market is a structural, not cyclical, challenge.
Right.
The consumer shift away from high fructose liquid sweeteners and ultra-processed foods, driven both by the permanent sticker shock of inflation and the biological rewiring caused by GLP-1 weight loss drugs, represents a permanent loss of volume for their starches and sweeteners division.
So people are just eating less junk food forever.
That's the bearish bet. And third, their immediate path to high-end growth is entirely subservient to government bureaucracy.
RBOs and 45Z.
Exactly. If the EPA delays the biofuel blending mandates, or if the Treasury Department creates overly burdensome rules for the 45Z tax credits, a massive, necessary catalyst for their 2026 stock growth simply evaporates into thin air.
That is a highly sobering, legitimate list of risks. It paints a picture of a legacy giant fighting a multi-front war against inflation, changing human biology, and Washington gridlock.
It does.
So what is the counter-argument? Why should an investor look at this transcript and feel confident about deploying their capital into this company?
The bullish case rests entirely on the sheer, unyielding financial gravity of their fundamental foundation. Let's start with shareholder return, because the transcript highlights a statistic that is almost impossible to comprehend in the modern, volatile tech era.
Okay.
In the fourth quarter, ADM paid out its 376th consecutive quarterly dividend.
Wait, let me do the math on that. 376 consecutive quarters. That is exactly 94 years of uninterrupted dividend payment.
94 years.
They have consistently returned cash to their shareholders through the Great Depression, World War II, the dot-com bust, the 2008 financial crisis, and a global pandemic. That is the definition of institutional resilience.
Absolutely. And that dividend is protected by a balance sheet that is currently built like a fortress. They ended 2025 with a leverage ratio of 1.9x, which actually beats their own internal target of 2.0x.
So low debt.
Low debt. They are sitting on $4.5 billion in restricted cash. They maintain a highly liquid overall cash position. And even in this quote-unquote difficult operating environment, they generated $2.7 billion in raw cash flow from operations before accounting for working capital changes.
And we know they pulled another $1.5 billion directly out of their working capital just by optimizing their silo storage and supply chain velocity.
Yep.
Plus, they have internal levers they're actively pulling to fight back against those structural headwinds we mentioned.
Oh, absolutely. They aren't passively accepting those elevated North American manufacturing costs. Management detailed an incredibly aggressive, comprehensive cost-cutting mandate.
How much are they cutting?
They are currently on track to physically extract $500 to $750 million in aggregate structural cost savings over the next 3 to 5 years.
Yes.
They are ruthlessly auditing their entire global footprint, optimizing their plant networks, and streamlining their corporate overhead to protect the bottom line.
So you have a company generating massive defensive cash flow, executing $500 million in active cost cutting, maintaining a pristine balance sheet, and paying a dividend with a 94-year track record. So synthesize the final verdict. What is ADM in 2026?
The verdict is that ADM is a highly defensive, cash-generating behemoth, currently navigating a painful but necessary transitionary period.
Okay.
They have definitively proven they possess the operational willpower to manage their downside effectively, pulling levers to protect their cash flow when the macroeconomic winds turn against them. However, they are currently landlocked. The ultimate catalyst required for the stock to break out of this transitionary phase and hit the high end of that $4.25 EPS guidance relies heavily on forces outside of their direct control. The clarity of domestic biofuel policy and the normalization of global trade routes.
Dominoes.
Right. If those external dominoes fall in their favor, their massive investments in decarbonization and precision fermentation will provide substantial upside.
And if they don't?
If the dominoes stall, you are still holding a resilient, fortress-like asset that pays a highly reliable yield while it actively restructures itself for the future.
Which brings me to a final, highly provocative thought for you to mull over as you analyze the broader market. We have spent this entire deep dive talking about agricultural services, crushing soybeans, trading grain, and reformulating liquid sweeteners. We collectively think of ADM fundamentally as a food company, a giant machine dedicated to feeding the world's human population and its livestock.
That is the legacy identity they have carried for over a century.
But listen closely to the underlying subtext of every major strategic investment outlined in this earnings call. With the rise of GLP-1 weight loss drugs literally biologically shrinking the caloric intake of the human race, the traditional volume-based food side of their business is facing a permanent structural wall.
Right.
But at the exact same moment in history, look at what is happening over in the technology sector. The massive, insatiable, explosive energy demands of AI data centers are stressing global power grids to their absolute breaking point.
Yes.
The physical world desperately needs new, sustainable, massive sources of liquid energy to keep the digital world running.
which perfectly aligns with ADM's massive pivot toward carbohydrate solutions, ethanol margin expansion, and heavily subsidized renewable diesel.
Exactly. Between the surging profit margins in the ethanol division, the billions being poured into low-carbon jet fuel infrastructure, and the literal carbon capture pipelines being buried beneath the Midwest, the agricultural industry is quietly, systematically transforming into the energy industry.
That's a powerful way to look at it.
It is no longer just about harvesting calories to fuel human bodies. It is about harvesting carbohydrates to fuel machines, data centers, and global transportation grids.
The fundamental mechanics of farming are being redirected. The genetically engineered crops of the immediate future might be planted just as much to power our server farms as they are to fill our grocery store shelves.
So I encourage you to take a hard look at your own portfolio. Consider how the massive, boring legacy companies you hold might be fundamentally pivoting their entire multi-billion-dollar business models right under our noses.
Because sometimes when the diagnostic reality of a company looks murky and confusing, it isn't because the machine is broken.
It is because the patient is rapidly evolving into something entirely new.
A phenomenal reminder to never take the headline numbers at face value and to always interrogate the physical mechanics driving the data.
Thank you for taking this deep dive with us today. We'll catch you on the next one.